Assalamu alaikum friends.
Let us introduce our character.
Me, Chantika as a lecturer.
And me, Jihan as a guest lecturer.
Hello everyone. My name is Samir as a college student 1. And me, Scott as a college student 2.
I hope you enjoy this video.
And, happy watching.
Assalamu alaikum.
Wa alaikum salam.
Ok boys, today's we would like to learn about Financial Analysis Chapter 11. Is about equity analysis and valuation. But today, I'm not alone, me and my friends Jihan. And she will help me to explain this chapter. She work in one of big company in Indonesia as an accountant. So that I hope that she can give some of her knowledge.
Wow, thank you ma'am. It sounds so interesting.
Okay, in this chapter is divided by 3 sub-materia. There are, earnings persistence, earning-based equity valuation, and the last earning power and forecasting for valuation. Earning persistence. Earning persistence is the key to producing the best equity analysis and valuation. And also generated profitability is the main goal of an analysis. Earning persistence include stability, prediction, variability, profit trend, profit management, the accounting methods used. Profit rearrangement and adjustment. 2 methods commonly used to help calculate earning persistence. There are. First, rearrangement of meaning. The goal is to be able to separate the stable, normal, and continuous elements related to earnings that can be separated and distinguished from random, indeterminate, unusual, and non-recurring elements. Second, is profit adjustment.
Excuse me ma'am. From where if we want to get information about earning persistence?
Good question. Okay, to compile and adjust earnings, we need relevant and reliable information. Where the main sources of this information, there are income statement, other financial statements and notes to financial statements, management discussion and analysis, rearrangement of profit and profit components. Recasting aims to rearrange the components of earnings in order to present a more meaningful classification with a relevant format for analysis. Components of earnings can be rearranged, divided, adjusted or deducted, but the total must be reconciled to net income for each period. The same treatment is applied to components such as equity in the profit/loss of subsidiaries that have not been reconciled. Components that are reported after tax should be excluded along with their tax effects if reclassified separately from continuing operating income. Profit adjustment and profit components. Question: who knows about adjustment main purpose?
Me ma'am. Adjustments have the main purpose of placing the components of earnings in the period in which the components of earnings should be reported.
Good. The adjustment process uses data from the rearranged income statement and other available information to determine the components of earnings for the period. Determinants of earnings durability. Profitability is determined by many factors. 1. Profit trend and persistence. 2. Earnings management and persistence. 3. Management incentives and persistence. Profit trends and persistence. Trends in earnings can be assessed through statistical methods or by financial statements that describe trends. Earnings trends often reveal clues about a company's current and future performance and assess the quality of management. Question: can you mention some forms of earnings management to watch out for?
I think changes in accounting methods or assumptions are included ma'am.
That's right Samir, and the other forms of earnings management to look out for are: first, eliminating extraordinary and unusual gains and losses by removing the impact on unusual and unexpected earnings that could adversely affect earnings trends. Second, the big bath is to recognize the expense of a future period in the present, if the current period's performance is very poor. This practice removes future burdens from future profits. Third, impairment. Impairment of operating assets such as plant and equipment and intangible assets such as goodwill when operating results are poor. Fourth, determining the timing of revenue and expense recognition, namely setting the time for revenue recognition and the expense of performing earnings management, including trend management. Management incentives and persistence. As analysts, they must recognize incentives for managers related to earnings. Initially, earnings management was often achieved by underreporting earnings. This creates a reserve that can be used in periods of low profit in the future. Given the performance incentives for managers, and the use of accounting numbers to control and monitor their performance, analysts must be aware of the potential for earnings management and even misstatement, persistence and temporary posts in profit. The rearrangement and adjustment of earnings for equity research relies on separating the stable and enduring components of earnings from temporary random components. An important part of the analysis is assessing the durability of the profit and loss components in earnings.
I want to ask, ma'am, what is our purpose in analyzing and interpreting this extraordinary item?
Great question, Samir. Okay, so the purposes of analysis and interpretation of extraordinary items are: 1. Specifies whether a post is temporary, not persistent. This process involves assessing whether the item is unusual, not an operating item, or non-recurring. 2. Determine the necessary adjustments after knowing the earnings persistence assessment. Okay class, for the next sub-material would present by my friends, Ms. Jihan. Hi, Jihan, thanks for coming, and now time is yours.
Okay, thank you Cans. Hello guys. Okay, thank you Kantika for this chance. Hello everyone, my name is Lusy Syafira, you can call me Mom Jihan. For this chance, as an accountant I try to explain about equity analysis to continue what is the Kantika explained before. For the next sub-topic, I will explain about profit-based equity valuation. Corporate valuation is an important goal for many users of financial statements because reliable value estimates can be used to make decisions. Under this method, the company's equity value is calculated based on the forecasted cash flows available to equity investors. The relationship between stock prices and accounting data. Future profitability is very important in assessing the company, namely by using the estimated net income and future book value. Accurate estimation of this measure can only be made after considering the quality and durability of earnings as well as the strength of the company's earnings. Various basic valuations. Two valuation measurements that are often used are the price-to-book value ratio and the price-to-earnings ratio. By comparing this basic ratio with the implicit figure in the current stock market price, we can evaluate the investment value of a publicly owned company. For companies whose shares are not actively traded, this basic ratio can be used as a tool for estimating the value of equity. Price-to-book value ratio. This is the formula to calculate price-to-book value ratio. The formula is equity market value divided by equity book value. These calculations yield several important insights. If the book value growth increases, then the PB ratio increases. In addition, when the cost of equity capital increases, the PB ratio decreases. It is worth noting that the PB ratio is not equal to 1 if the market expects abnormal profits, both positive and negative, in the future. Okay, next is price-to-earning ratio. Question: who knows the formula how to calculate price-to-earning ratio?
I would like to answer, ma'am. The formula is equity market value divided by net profit.
Good, it is true. The formula to calculate price-to-earning ratio is equity market value divided by net profit. This equation provides two important insights. First, the P ratio is inversely related to the cost of capital, i.e. this ratio is lower for a higher cost of equity capital. Second, the P ratio is positively related to the estimated growth in earnings per share relative to normal growth. Okay guys, maybe that's all about what I would like to explain today. Hope you understand. Thank you.
Okay, Jihan, thank you so much for coming and give my students some new knowledge.
You're welcome, I'm so happy today.
So happy to hear that. I hope this moment will happen again next time.
Of course, feel free for me to accept your invitation to be a guest teacher again. Your student is very smart, Red Heart.
Thank you for coming, ma'am. See you next time.
You're welcome, bestie.
Okay guys, before we move to the last sub-material, I would like to ask, what do you think of the lesson Ms. Jihan taught?
Clear enough, ma'am, because we must know the formula before analyze.
Okay, Samir, thank you. Okay, move to the last sub-material. It's about power of profit and estimate for valuation objectives. Profit power. Earnings strength is the level of company profits that are expected to occur in the future. With few exceptions, earning power is recognized as a major factor in company valuation. Accounting-based valuation models include the capitalization of earning power, where this capitalization involves the use of a factor or multiplier that reflects the cost of capital and estimates of future risks and returns. Measuring profit strength.
Ma'am, I want to ask, how do we calculate earnings power?
Financial statements are used to calculate earnings power. Although assessment is future-oriented, we must recognize the relevance of a company's current and past performance for estimating future performance. End-of-period earnings that exceed the business cycle reflect actual operating performance and provide us with a perspective on operating activities from which we can estimate future performance. Profit power time span. The best measurement of a company's earning power is to use the average cumulative profit over several years. Question: who knows how long the average time span was used to calculate this profit?
Me, ma'am. Maybe about 3 years.
Thanks for the answer, Samir, but it's not a correct answer. The time span for calculating average earnings is generally 5 years, usually up to 10 years. Extending this period reduces distortion, irregularity, and other temporary effects that reduce the relevance of 1 year's earnings.
Why not 5 years?
5-year profit calculations often emphasize past experience while avoiding irrelevant performance. Adjusting earnings per share. Earnings power is calculated using all components of earnings. Each item of income and expense is part of the company's operating experience. Estimated profit. Forecasting earnings follows component analysis of earnings and involves making estimates of future earnings. Profit forecasting mechanism. Forecasts require us to use all available information effectively, including prior period earnings. Estimates also benefit from disaggregation. Splitting involves using profits by product line or segment and is especially useful if the segments have different risks, profitability, or growth. Elements of forecasting profit.
Ma'am, last night I was read a book. Can I explain about this?
Of course you can. You can stand up.
Thank you, ma'am. An element of profit forecasting is checking the reasonableness of the predictions. For this purpose, the rate of return on investment is often used. If earnings forecasts produce returns that are markedly different from past returns or industry returns, we must reassess the forecast and the process. Return on capital investment depends on profit, while profit is a product of product quality management and asset management. Maybe that's all. Thank you.
Good job, Samir. You can sit down. Reporting estimated profit. Management estimates differ from estimates made by financial analysts. Estimates depend on access to information and assumptions. The SEC recommends that estimates be presented in a financial statement format and accompanied by sufficient information for investors to make a judgment. The SEC has safe harbor rules that protect companies from lawsuits if their predictions don't come true. Interim report for monitoring and revising profit estimates. Interim financial reports are a valuable source of information for monitoring performance. This report is useful for revising the estimation of earnings strength and profit forecasting. Interim financial statements have limitations in placing the profit component for a period of less than 1 year. Period end accounting adjustments. Determining operating results for a 1-year period requires some adjustments to accruals and estimates. These adjustments include recognizing revenue, determining inventory costs, allocating overhead, finding the market value of securities, and estimating bad debts. Seasonal impact on business activities. Some companies have seasonal business activities. Sales, production, and other operating activities often cannot be divided equally between interim periods. This can distort interim earnings comparisons. In addition, it can also cause problems in the allocation of discretionary costs, such as advertising, research, development, repair and maintenance. SEC interim reporting requirements.
Excuse me, ma'am. Like Samir before, I want to try to explain this.
Great, of course you can. Please stand up.
Thank you, ma'am, for the chance. SEC interim reporting requirements. First, comparative interim reports and financial statements up to this date are entitled unaudited, but must be included in the annual report. Second, comparative balance. Third, cash flow statement to date. Fourth, pro forma information about business combinations recorded as purchases. Next, conformity with generally accepted accounting principles and disclosure of accounting changes, including letters from auditors. And also, management narrative analysis of operating results. The last is disclosure of whether Form 8K was filled out during the period, reporting whether there were unusual earnings adjustments or auditor changes. Interim report impact analysis. The last is about interim report impact analysis, and here maybe Samir want to explain this? Oh, thank you, Scott. Based on what I read last night, analysts should be aware of the estimation errors and discretion inherent in interim reports. This is because the limited involvement of the auditor in the interim report reduces the reliability of the interim report relative to the audited annual report. Maybe that's all, ma'am.
Good, Scott. You're welcome. You can go sit down. And thank you so much to Samir and all student here. Okay, class, thank you for joining class today. Me and my friends Jihan beg your pardon if we had mistake in our presentation. The last I say, wassalamu alaikum warahmatullahi wabarakatuh.